Imagine holding the keys to a vault that contains literally 1 out of every 6 rupees in the entire Indian mutual fund ecosystem.
Which is just a staggering amount of capital.
Right. And the crazy part is you don't even own the money. You just, you get paid to watch it sit there day after day, year after year.
It really is the ultimate toll bridge business.
Exactly. And for decades, regular investors couldn't buy a piece of this vault. But that's changing. So, welcome to this deep dive. Today, we are unpacking a really detailed FinShots article about a landmark moment in Indian capital markets.
Yeah, the highly anticipated SBI Funds Management IPO.
Right. It's huge. But before we get into the mechanics of all that machinery, we do need to establish our strict disclaimer right at the top.
Always important.
Yeah. We are drawing entirely on the analysis provided in the source material from FinShots. This deep dive is purely an analytical look at the business model, the macroeconomic dynamics, and, the valuation.
Right. This is absolutely not financial or investment advice.
Exactly. You always need to do your own due diligence before making any investment decisions. So, with that out of the way, okay, let's unpack this. Because the irony here is just, it's what makes this such a fascinating case study.
It really is.
Yeah.
Millions of people have money flowing through this specific company without ever, stopping to consider the actual business model of the entity itself.
Right. Like we all just mindlessly set up our SAPs, the systematic investment plans. We let the money leave our accounts on the 5th of every month, and we essentially just forget about it.
We obsess over our own portfolio returns.
Yes. But we rarely look at the invisible mega corporation that is, well, getting incredibly rich just by managing that flow of capital. But today, we are finally getting a look under the hood.
And to really evaluate this IPO, we first have to map out the sheer scale of SBI Funds Management. Because when we talk about market dominance, the numbers here are almost structural.
Yeah, the source outlines that they currently hold a 15.3% market share.
Meaning 1 in every 6 rupees in the entire Indian mutual fund space is managed by this single company.
It's wild to think about. They are bigger than HDFC, they're bigger than ICICI or, any other competitor.
And that's buoyed by an army of 16 million SIPs quietly topping up every single month.
Right. 16 million.
Yeah.
Which brings us to this really unique structural quirk of the IPO. Because usually when a company of this massive scale goes public, they're hitting the market to raise fresh capital, right?
Right, to build infrastructure, fund acquisitions, maybe expand.
Yeah. But SBI Funds Management isn't raising a single rupee of fresh capital for the company itself.
What's fascinating here is the structure of this deal. It's an offer for sale or an OFS.
Okay, break that down for us.
So the two existing owners, State Bank of India, which currently holds about 62% of the equity, and the French asset manager Amundi, they are simply offloading portions of their existing stakes to the public.
So no new money is going to the company.
Exactly. 0 new shares are being created, and 0 cash is going onto the company's balance sheet.
Okay, so I was thinking about this, and let's use an analogy for how this works in practice. Think of this IPO like an insanely successful neighborhood bakery.
Okay, I like where this is going.
Right, so there's a line out the door every morning. They sell out of croissants by 9 a.m. The business is a total cash-generating machine.
Right.
So when the owners take it public via an OFS, they aren't selling shares to the neighborhood to go buy more ovens or open a second location.
Because the bakery already has all the ovens it needs.
Exactly. The owners are just cashing in on a slice of the pie they've already baked. They're letting the public buy into this existing stabilized profit stream.
And, taking that bakery analogy a step further, an OFS often triggers some unwarranted skepticism among retail investors.
Oh, for sure. People think, why are they selling? Is something wrong?
Exactly. There's this immediate assumption that if the founders are selling, they must be bailing on a sinking ship. But in reality, excellent businesses that don't need money to fund operations often list this way.
Right, they've just reached terminal scale.
Exactly. They list this way because the owners are finally unlocking the illiquid value they've compounded over all those years.
So since they don't need the IPO money for new factories or growth, what exactly does the current financial engine look like?
Well, asset management is arguably one of the most structurally advantageous business models in modern finance.
Because there's no inventory, right?
Exactly. No physical inventory, no factories, no meaningful debt. A traditional business is bogged down by capital expenditure. SBI Funds Management operates in a completely different reality.
They just construct investment schemes, gather capital, charge a predictable fee, and let the broader economic compounding of the equity markets do the work.
And the defining characteristic of this model is the compounding magic of fixed costs.
Right.
Paying your fund managers, maintaining a robust research desk, handling compliance. These costs are roughly the same, whether you're managing 1 lakh crore or 12 lakh crore.
Managing a larger pool of money doesn't require, proportionately more analysts.
Exactly. And the source puts their total assets under management, their AUM, at a staggering 12.5 lakh crore rupees.
Wow.
Because that denominator is so massive, those fixed costs are spread incredibly thin. Their operating costs are an incredibly low 0.08% of assets.
That is lean. I mean, especially when you look at the top 10 competitors who generally sit somewhere between maybe 0.0 and 0.25%.
Right. SBI is operating far leaner purely by virtue of its massive asset base.
So what does that actually look like for the bottom line?
Well, last year, on 4,389 crore rupees in revenue, they kept 3,067 crore as pure profit.
That's a jaw-dropping 70% profit margin.
It's massive. And just a couple of years prior, that profit figure was around 2,073 crore.
Okay, wait. I do have to push back a little on this whole narrative of management genius here, though.
Oh, so?
Well, if the costs are structurally fixed and the profits jumped by 1,000 crore in just a couple of years, isn't this essentially just the result of them sitting still?
I see what you mean.
Right. Like India underwent this massive SIP boom, the tide rolled in, and didn't they basically just let India's massive cultural shift in savings do all the heavy lifting?
That is a highly accurate read of the situation, actually. They benefited immensely from that macroeconomic shift into equity markets.
They just happened to own the biggest bucket on the beach.
Precisely. But relying on macroeconomic tailwinds means you're also exposed when the current changes direction.
Right.
And the FinShots analysis outlines 2 very specific threats to this effortless money printer.
So let's look at the first major catch, the passive fund threat, because a 70% margin looks beautiful on paper, but every beautiful business has a catch.
Right. We are witnessing a fundamental rotation in the industry. Historically, the engine has been actively managed funds.
Where star managers pick stocks and charge, 0.75 to maybe 2.43% in fees.
Exactly. But the industry is shifting toward passive funds, like index funds and ETFs, that just mirror the market mechanically.
And those passive funds charge drastically lower fees, sometimes as little as 0.04% a year.
Right. Now, if we connect this to the bigger picture, the paradox for SBI is that they aren't getting left behind by this trend.
They're actually leading it, right?
Exactly. They are India's largest passive manager with a 28% market share. Passives now make up a third of their total mutual fund assets.
Here's where it gets really interesting, though, because it's kind of like a high-end restaurant transitioning its business model.
What do you mean?
Well, imagine a steakhouse that used to sell these expensive, handcrafted $50 steaks. That's the active fund, right? High margin.
Okay,
But then they transition into becoming this massive automated vending machine that just sells $1 sodas. That's the passive fund.
Right.
The volume is huge. The foot traffic is astronomical. But the actual profit per transaction completely plummets.
That is a perfect analogy.
Yeah.
The volume of passive inflows is masking the underlying margin compression. SBI is gaining more total money, but making much thinner margins on it.
Because every rupee that shifts from a 2% active fee down to a 0.04% passive fee, SBI earns just a fraction of what it used to.
Exactly. And that's just the internal shift. It isn't just the customers choosing cheaper products that is squeezing margins.
Right. There's a second catch, the regulator squeeze.
Yes. The government is actively stepping in to force fees down even further.
Because SEBI, the regulator, has a mandate to protect ordinary investors.
Right. In April 2026, SEBI rolled out aggressive new mutual fund rules explicitly designed to bring costs down.
And SBI hasn't been shy about the impact of this. The article notes they've openly admitted these new rules will squeeze their yields.
They actually said it will force them to fundamentally restructure its cost base.
Wow. Which is wild for a company that runs on fixed costs.
This raises an important question, though, about the tension in a publicly traded asset management company.
Think about this for a second. The exact SEBI rules that are fantastic news for you as an everyday SIP investor, keeping more compounding capital in your own portfolio.
Right.
Those exact same rules are terrible news for you if you become a shareholder in the SBI Funds Management Company.
It is a direct, mathematically unavoidable conflict. Consumer benefit versus shareholder value.
So knowing all of this, the incredible scale, but also the impending squeeze on those 70% margins, how is the market actually pricing this IPO? Is the price fair?
Well, looking at the source, the shares are priced between 545 and 574 rupees.
Okay, and what does that mean for the total value?
At the upper band, the entire company is valued at 1.17 lakh crore rupees,
Making it the highest valued asset manager in Indian history.
absolute highest. However, if we look at the price-to-earnings ratio, investors are paying 36 to 38 rupees per 1 rupee of profit.
Which surprisingly is actually moderate compared to their listed rivals.
Very moderate. HDFC trades around a 42 PE. ICICI is at 49. Nippon is up at 51.
So SBI is cheaper than all of them.
Exactly. You only find cheaper valuations with the smaller players like Aditya Birla at 34 or UTI at 32.
So what does this all mean? I mean, if they are the biggest and most profitable player in the room, why are they priced cheaper than ICICI and HDFC?
The market is forward-looking. The risk here is that you are paying a premium for SBI's exceptional historical profit margins, right at the exact moment things are changing.
Ah, so is the market already sniffing out the margin squeeze and pricing it in?
Exactly. They know the passive shift, and the new SEBI fee rules are pressing down hard on SBI, especially since they have that massive 28% passive market share.
Right. So to kind of synthesize all this, betting on this stock isn't really a bet on SBI's genius stock picking abilities, is it?
Not at all.
It's more of a macroeconomic bet. It's a bet on you, your neighbor, and millions of other Indians who now just open an SIP the exact same way the previous generation used to open fixed deposits.
That's exactly it. The ultimate question, the real gamble for a shareholder, is whether sheer scale, that endless flood of new SIP money, can outpace the shrinking fees.
Because those fees are trending closer and closer to zero, going from 2% down to 0.04%,
Right.
which leaves you with this kind of lingering thought. As fees get practically microscopic, what happens if a radically lean, tech-first disruptor enters the mutual fund space?
Well, that would change everything.
Right. I mean, imagine a company with absolutely zero legacy costs, no massive headquarters, no old-school infrastructure.
It's really algorithmic.
Exactly. Will a giant like SBI, which already admits it has to fundamentally restructure its cost base, be too bulky to survive a true race-to-the-bottom fee war?
It's the ultimate innovator's dilemma.
It really is. Something to mull over the next time you check your mutual fund app. Well, thank you for joining us on this deep dive.
It was a pleasure.
Keep questioning the financial machinery around you. Sometimes the biggest giants are the ones hiding in plain sight.